to all those who will be seeing it later on YouTube, depending upon whenever you see it. This is the session in continuation of our discussion about deductions from gross total income. We already had one session one day back, where we have covered some part of this particular topic, and the remaining provisions related with this deductions from gross total income that we will be covering in this particular session. Okay. In the first session, we have generated that overall idea that whatever are these deductions from gross total income, this is basically chapter 6 of income tax. So they can be segregated into three different parts. One is deductions based on certain payments. Second, deductions based on certain income, and then certain other deductions related with the assessee, a person with disability, and all those. So with respect to deductions based on payment, we have covered section 80C to 80G of income tax. The last section which we have discussed in the last session was the section 80G, deduction with respect to certain donations given by the assessee. Okay. So today we shall be continuing our discussion after this section 80G. The first section for our today's discussion the first section for today's discussion is going to be section 80G, deduction in respect of rent paid by the assessee. Okay. I'm really happy to see already queries have started coming on the query board. Let's keep this whole discussion as interactive as possible. Only by raising the queries you will be able to learn number of finer concepts of this topic. Okay. So one query is from Mansha, Delhi. This is Mansha, not related with the topic in hand. So my suggestion would be, please restrict our discussion to whatever topic we are discussing. We are talking about deductions from gross total income. So let's restrict our discussion to that particular topic only. Okay. Fine. So first section for our today's discussion, section 80G, deduction in respect of rents paid. Okay. What is this particular provision? As we have discussed in the last session, it is very important to develop an approach how to read a particular section. Okay. What are the important points which I need to see in a particular section? So with respect to all these payment-based deductions, we need to basically look for three clarities. One is, who is eligible to claim this particular deduction? What type of assessees will be entitled for this section? Second, what is eligible? What kind of payment shall generate this deduction to me? And then how much is the deduction, the quantification, the calculation aspect. So keeping in mind these three aspects, let's start this first section, section 80G. Who is eligible? Type of assessee, only individual. And in this whole payment-based deduction, there's a very confusing sort of situation. Which deduction is available only to individual? Which deduction is available to individual and HUF both? Section 80G, we had a discussion in last class, which is available to all types of assessees. Apart from 80G, all other sections, either they are available to individual or they are available to individual and HUF both. So 80G is available only to individual. Now, since Act is talking only about individual, not saying anything about a residential status, that means assessee may be resident or non-resident both, but it should be only an individual assessee. Okay. Now, deduction is available for what? What is eligible? Who is eligible? Any individual. What is eligible? Payment of rent for any accommodation occupied by the assessee for his own residence. rent paid for self-residential accommodation is what is eligible for this section. One small condition, if this amount of rent is more than 2000, then it cannot be paid by way of cash. It has to be by any mode other than cash. Okay. Now, amount of deduction. And as usual, this you must have noticed in the last class also, this whole discussion is based on PPT. PPT is focusing on all the salient points. I have deliberately developed a PPT which doesn't contain unnecessary clutter, which doesn't contain unnecessary information. We directly focus on the main aspect of that particular section. So type of assessee, type of payment, amount of deduction, how much deduction would be available. Now, ATGG requires me to calculate three figures. Least of these three would be the amount of exemption. What are these three figures? First is rent paid minus 10% of adjusted gross total income of the assessee. What is this adjusted gross total income? We will be discussing later on. But right now, the idea is this: whatever is the 10% of my adjusted gross total income, over and above this 10%, whatever rent I have paid, that excess figure is the first amount for this ATGG deduction. Second is rupees 5,000 per month, 60,000 rupees in a year. So this is my second figure. And the third figure is this 25% of the adjusted gross total income. Three figures, least of this three is the amount of exemption under section 80GG. So we can see there is a maximum ceiling, 5,000 rupees per month, that is 60,000 rupees in a year is the maximum deduction one can claim under this particular section, subject to two other figures also. Now, first and third figure requires something called adjusted gross total income, AGTI. Now, what is this adjusted gross total income? Adjusted gross total income is something similar to what we have discussed with respect to section 80G. Okay, so adjusted gross total income for the purpose of this ATGG, of which 10% or 25% is to be calculated, is my gross total income as reduced by 3 or 4 items. What are the 3 or 4 items? First is all deductions under chapter 6 except deduction under this particular section, that is to be reduced. Second, all the long-term capital gains are to be reduced. Long-term capital gains either taxable under section 112 or taxable under 112A. All the long-term capital gains are to be reduced. Short-term capital gain, only that short-term capital gain which is covered under section 111A. That is short-term capital gain, taxable at a special rate of 15%. STT paid transaction short-term capital gain, that is to be reduced. And then other income which are taxable at a special rate under section 115A, AB, AC, AD, etc. These income are also to be reduced. So my gross total income minus 1, 2, 3, 4 figures. These items I will be reducing. I will be getting something called adjusted gross total income for section 80GG. 10% of that adjusted income or 25% of that adjusted income that I need to calculate for finding out how much is the maximum deduction one can claim under section 80GG. Deduction is available in respect of rent paid by my assessee for his self-residential house. Now, there are certain further conditions. Who is entitled, what is entitled, and how much is entitled. Who, what, and how. WWH. These three aspects we have discussed. And this WWH is something you all can keep in mind. All these payment-based deductions, starting from section 80C to 80GGC, this WWH. Who, what, and how much. These three would always help you to get a clarity about the crux of that particular section, the most important part of it. After this, now there are certain conditions to be fulfilled. If I want to claim ATGG deduction, First of all, I should not be getting any income by way of HRA. Now, you should be able to understand this. If I'm getting an HRA, then whatever rent I'm paying, I will be claiming a deduction from HRA. So if I'm paying a rent and I'm getting a deduction from HRA, then obviously 80 double G would not be required. Only when I'm not getting any HRA and I'm paying any rent for my residential accommodation, then only I can claim 80 double G deduction. Okay. Then second condition. I am residing in a resident. I'm staying in a rented accommodation. For this rent, I'm claiming a deduction. But in the same city where I'm staying, I'm paying a rent. I myself or my spouse or my minor child or my HUF owns a residential house. Then there would obviously be a question, if you or your this close relative, they own a residential house, why you are staying in a rented accommodation? So that's why law has created the second condition, that if you want to claim 80 double G deduction, then in the city in which you are residing, you yourself, spouse, minor child, or your HUF should not own any residential accommodation. Then only 80 double G deduction can be claimed. And third is, you yourself should not own any residential accommodation which you are claiming as your self-occupied property. For income from house property purposes, if you are claiming any property as your SOP, self-occupied property, now this will create a dichotomy. This will create two different situations. One property you are saying this is my self-occupied property, and then you are also saying I'm staying in a rented house, give me 80 double G deduction. Both things are not possible. Something is wrong somewhere. So that's why law says if you are claiming an exemption of any property as a SOP, self-occupied property, then 80 double G deduction would not be available. So three conditions are to be fulfilled. Then only deduction under section 80 double G can be claimed by the assessee. So this is what something simple kind of section 80 double G, deduction in respect of rent paid for any residential accommodation. Okay. If any query is there, we can discuss it right now. Okay. So then we come to next two sections, again related with the deductions based on payment, 80 double GB and 80 double GC. Okay. For the purpose of our discussion, these are going to be last two sections related with the deductions based on certain payments, payment based deduction series. These are last two sections we will be discussing, 80 double GB and double GC. Normally in the books, you will find these two sections discussed separately, but because they are of common nature, so it will help to discuss them simultaneously. From examination purposes, for ease in understanding purposes, it would be better if we discuss both these sections simultaneously. In book, you will find they have been discussed it too in one by one manner, but it will help to discuss them simultaneously to get a better understanding. 80 double GB and 80 double GC, contribution to political parties. Simple, not much of the complication. Now this deduction is available to whom? Who is eligible? WWH. Who is eligible? What is eligible? And how much is eligible? Okay. So type of assessee. First is Indian company, 80 double GB, and then any other person other than local authority or artificial juridical person which is funded by government. So 80 double GB deduction is for Indian company. 80 double GC is this for any other person. Okay, other than persons who have been funded by the government, all other persons can claim it under 80 double GC. Okay. What is eligible? Who is eligible? Simple. Indian company and then all other persons. Then What is eligible for deduction? This is common in both the sections. Any amount contributed to a political party, any donation given to a political party, that will qualify for the purpose of 80GGB, 80GGC deduction. Okay, so you can give a donation either to a political party, or you can give donation to an electoral trust. Electoral trusts are bodies formed to give donation to political parties. So either you can give a donation directly to a political party, or you can donate to an electoral trust, and that trust would be donating that lump sum money to the political party. You as a contributor, you as a donor may give donation either of them, either to political party or to an electoral trust. Okay. The only requirement is this cannot be a cash donation. Now, whatever is the amount, even 100 rupees is the amount, it has to be by any mode other than cash. Simple. Okay. And then if this has been done, how much is the amount of deduction? WWH. Who, what, and how much? Very simple, no calculations, no restrictions, no limit, nothing. Whatever is the amount you have paid, the total amount is allowed as deduction. To a charitable organization, you give a donation, you get a deduction only of 50%. To a political party, you give a donation, you get a deduction of 100%. Okay, so you can give donation directly to the political party, or you can give donation to an electoral trust. You may be an Indian company, 80GGB deduction is available. You may be any other person, 80GGC section would be applicable. Both the cases, whatever is the amount of donation, the total 100% amount would be deductible. Okay, so this is all about deductions which are based on certain payments. Okay, then we will be starting our discussion about deductions which are related with certain income. Fine, but before this, let's have certain queries. Two queries I am having with respect to 80GG, the deduction in respect of rent for residential accommodation. Yeah. First query is Ambika from Mumbai. Sir, can SOP be at any other city which is not near his workplace? Yeah. Okay. For the benefit of everybody, let me describe the question. This is a very interesting, very important clarification. 80GG says that assessee should not have any property which is being treated as an SOP. In the city in which he is residing, he or his spouse or his minor child or HUF should not have any house property. Assessee himself should not have any property which is being treated as an SOP. So that property which is being treated as an SOP may be in the same city, it may be in any other city. Assessee might be saying that, okay, I'm staying in Mumbai in a rented house, and then I'm having a self-occupied property somewhere in Indore. The point is, both the things are not possible. If you are residing in Bombay, then you cannot have a property in Indore which you say it is my self-occupied property. So that's why law has said that this SOP in any city, if a property is there and which as a assessee you are claiming this is a self-occupied property, you cannot claim 80GG deduction. Okay. Or for the sake of simplicity, you can keep in mind simply, either you can claim exemption as an SOP, or you can claim a deduction under section 80GG. Both simultaneously cannot be claimed. Okay, Ambika. Fine. Then we have another query from Ramya, Tiruvananthapuram. If the residential accommodation is owned by major child, can assessee claim 80GG? Section is specifically talking about property owned by minor child. Then 80GG is not available. That means if the property is owned by major child, 80GG is available. No restriction. This whole majority minority issue of children, we have a very interesting discussion in our last session also. So when the act is specifically talking about a particular type of child, they are not talking about any child, they are talking about any minor child. That means property owned by major child, 80GG deduction can be claimed. Yes. Okay. Any further queries related with this payment-based deductions? Okay. Sure. So now we come to the second set of deductions which one can claim from the gross total income, that is deductions in respect of certain income. Chapter 6A, part C of the income tax. Okay. Keep in mind this part C. This part C is the term we are going to use a number of places. Part C basically refers to all the deductions which are related with certain income. Okay. Now, before we start our discussion about every single section, let's try to generate some basic clarities in order to get a conceptual clarity about the basic nature of all these further sections. All these sections which we are going to discuss now onwards, they will be talking about deduction in respect of certain income. Now, this point I have made in the first session also with respect to payment-based deductions, what we have just completed our discussion. With respect to payment-based deduction, in the examination question, you will be given some additional information. If an examiner wants you to calculate any of these payment based deduction, then he will be definitely giving you some additional information. Okay, he will give you all the data about income, different types of income, everything, and then he will say, okay, assessee has given a donation of rupees 50,000 to so and so political party. So by reading that particular section, you will be able to easily make out that, okay, now I need to calculate this deduction. Now I need to allow this deduction under this particular section. A specific information is given to you, and that information would be useful only for the purpose of that deduction. With respect to income-based deduction, you will face a different problem in examination. With respect to income-based deduction, there will not be any separate information in the question. And this is the area, this is the point where number of students makes a mistake. The information has been given about various types of income. Now, all these income you need to consider for calculating gross total income. Once you have considered that income for calculation of GTI, you might feel that, okay, my purpose has been served. This information I have used for calculating gross total income. You need to keep in mind that, okay, the same income based on which I'm calculating GTI, this may be eligible for some kind of deduction subsequently in chapter 6A. So same information may be used twice. The same information is to be used with respect to say same income, same information is to be used with respect to calculation of that gross total income, and the same is to be used for allowing some deduction to the assessee. So this is something very important with respect to these income based deduction. They will not give you any separate information. They will not give you that, okay, this is the income, please consider a deduction under so and so section also. They will simply give you information about income. In your mind, it should be clear that this income is to be first included in the total income, and then the same income should be considered for deduction also. Okay. So something very important related with this whole part C, deduction in respect of certain income. Okay. Okay, one query we are having again. Section 80JJAA is also payment-based deduction. Sumit from Jaipur. Sumit, 80JJAA is altogether a different type of deduction. We will be discussing it separately. It comes in between. It comes in between income-based deductions, but that's a separate kind of deduction. We also will be discussing it separately. After we will be completing this whole income-based discussion, then we will be talking about 80JJAA. Okay, So deductions in respect of certain income, chapter 6A, part C of the income tax. Collectively, this is called part C. We will be talking about various sections in this part in a one by one manner. Okay. Again, what would be our method of study? What should be our method of study? Simply opening the section and starting it may not be sufficient. I need to have a clarity what I should look for in each of these sections. So again, first thing I need to look for is who is eligible, which activity, which assessee would be eligible. Second, what is eligible, which income shall be entitled for this deduction, and then how much would be the deduction one can claim. Okay, so let's start one by one. First is section 80 IAC, exemption to startups. First section which we would be covering in this discussion is this 80 IAC, exemption to startups. Okay, so section itself should give me an idea who can claim this deduction. Any entity which is a startup entity. Now in income tax, whenever I use any term, it always have a definite meaning. Startup is a term I keep on reading, hearing a lot here and there, but for taxation purposes, I need to find out exactly who can be treated as startup. We will be discussing this. Okay. So exemption to startup. Okay. Available to who is entitled, who can claim. Any eligible startup. Okay, so who are eligible startup, we will be discussing it. Okay. Okay, again we have a query. Sumit Agrawal from Mathura, please explain section 80AC. Okay, Sumit, we will be discussing 80AC later on. In my whole discussion, I not necessarily go in a section by section manner. I go more in a logical manner. What we needed to understand in a logical step by step manner. So let's first get through with this whole income based deductions. Then we will come to 80AC. Okay, Sumit from Mathura. Fine. So deduction is available, 80IAC, deduction is available to any eligible startup. My assessee, my entity should be eligible startup. In examination, if they have used this word, they have given that assessee is an eligible startup, then only I need to consider this 80IAC as a deduction. Okay. Now, what is the income? For which income I can claim this deduction? Yeah. If my assessee is an eligible startup, profits derived from the eligible business would be eligible for exemption. Whatever profits the startup is deriving from eligible business, these profits shall be entitled for deduction. Okay, how much would be the deduction available? This is the basic crux of this section. This much at least everybody should know. After this, there are a number of other provisions, but number of time it happens. We become so involved in a number of things that we sometimes lose focus on the main part of the provision. And that's why in my PPT, I always focus first on the main part. This much everybody should know. Then all other are related incidental provisions. How much is the exemption one can claim? 100% of the profits of eligible business. So this is the first basic understanding. Entity should be an eligible startup. Profits and gains from the eligible business, 100% of these profits would be entitled for exemption under section 80 IAC. Okay. Now let's go to the deeper understanding of this other related incidental provisions. Period of exemption. Now, this exemption is not available perennially to me. It is not available throughout the lifetime. All these payment-based deductions I can claim every year, except that ATE, higher education loan interest, that can be claimed only for 8 years. All other payment-based deduction I can keep on claiming year by year basis. This ATIAC available only for the limited period of time. What is this period of exemption? I can claim this exemption in any of the 3 years within first 10 years of the incorporation. Okay. My first 10 years of incorporation, and in these first 10 years, I can claim the exemption in any 3 years. When law talks about any 3 years, it actually means any 3 consecutive years. Okay. So once I have started claiming the deduction this year, next year, and then the next year, all in all 3 years, I can claim this deduction. Now, there's something important. Which 3 years law is giving an option to the assessee. You can claim this exemption in first 3 years. You can claim this exemption in last 8, 9, 10th year. You can claim this exemption in between 4th, 5th, 6th, whatever you want, subject to fulfillment of certain other conditions. You can claim it in any 3 years. Again, try to get some logic of this particular requirement. We all know all these startups, all these new businesses, normally they make huge losses in the starting years. So if law gives you an exemption from the profit, the very basic requirement, you should have a profit. If you are already having losses, then the exemption is of no use. And that's why law has given you this 10 years window of time. This is possible in starting 3-4 years, you might be having losses. Next 2-3 years, you might be carrying forward those losses and adjusting those losses. So ultimately, your tax liability may start somewhere in the 7th or 8th year. So then you can start claiming this exemption in those last 3 years also. Up to you, up to the assessee. You may decide which 3 year. It has to be 3 consecutive years. You can claim the exemption under section 80IAC. Okay. Further requirements. Now further provisions of the sections. But whatever we have discussed in this first slide, this is the base. This is the minimum thing. This we all should be clear about. All other provisions are important for each one of us, but this is something which is very basic. Now other requirements, the conditions which are to be fulfilled. If I want to claim an exemption under this section, I need to fulfill certain conditions. The first condition is this. Whatever is written in the law, let's go to the actual meaning of it. The first condition is this, that this should be a new business. Should not have been formed by splitting up, revival, or reconstruction of a business already in existence. Government wants to encourage startups in the country. They want more and more persons should come to this particular area. More and more startups should start functioning. Now the purpose would be defeated if I am already having an old business. I simply revive it, reconstruct it for the purpose of claiming this exemption, and then I start claiming the exemption. Now it is not actually a startup. So that's why law has said that business should not be formed by splitting up, reconstruction, revival of any business which is already in existence. That means we can simplify it. The business should be a new business. Okay. Now, second condition. If you see clearly, then the second condition basically further clarifies the first itself. First condition says it should be a new business. So second condition says that plant and machinery used for the purpose of business should be new. No old plant and machinery should be used. If you are using new plant and machinery, then only you are a new business. If you are using second-hand old plant and machinery, then you are not a new business. So then the second condition is this: the undertaking, the business should not have been formed by transfer to business any old plant and machinery. You should not have used any old plant and machinery. But having said this, then law has given two relaxations. First relaxation, they are saying that if you are importing any machinery in India, even if it is an old machinery, but it is being imported from a country outside India, never used in India prior to its import today, then this will be treated as a new machine. In India, we already have a fancy for imported items. So in law also, the fancy is there. And that's why they say Any Indian plant and machinery, if it is old, we won't accept it. You import it, then this will always be treated as new machinery for the purpose of this section. Then second relaxation they have given, if I say no old plant and machinery should be used, then sometimes that may create a problem. I might be having say 50 crores worth plant and machinery, and out of that 50 crores worth plant and machinery, even 5,000 rupees plant is an old one, I may have a problem. So now law says that, okay, we are not that much rigid, we are not that much restrict. Out of your total plant and machinery, you can use 20% as old one. Imported will be treated as new. Considering imported as new, out of your total plant and machinery, you may have an 80-20 ratio. If 80% is new, 20% is old, still this will do. We will give you this exemption for startup. Okay, so no old plant and machinery is to be used. And then the business should be a new one, should not have been formed by revival, splitting up, reconstruction of already existing business. Okay. Next condition. Now this condition is related with the original requirement, where we have said that assessee should be an eligible startup. It should be engaged in the eligible business. Okay. So they have given a general criteria about the business which will be eligible for the purpose of this deduction. A very generalized criteria is there. We all can understand it in the general sense. Should be engaged in some innovative kind of ideas, innovation, development, or improvement of the products, business model with a high potential of employment generation and wealth creation. Some generalized criteria they have given. It should not be a routine, a traditional trading kind of business. It should have something new economy, new age kind of business, something like Flipkart or Ola, Uber kind of business must be there. So innovative idea must be there, high potential of employment generation, high potential of wealth creation should be there. Okay, this is important. The definition of business may not be of that much important from examination perspective, but this date is important. This entity which is claiming exemption must have been incorporated between this 1st April 16 till 31st March 21. So we all can realize practically this year is the last year for this particular section. Entity incorporated after 31st March 21 will not be entitled for this deduction. Okay. Third, and again very important requirement from examination perspective also, there is some amendment applicable from this year. So whenever there is an amendment in any provision, that automatically becomes important from exam. At least for May exam, we normally say May attempt is amendments attempt. So there is an amendment. Earlier there was a different limit. Now the law is saying that for claiming this deduction, the total turnover of the business should not exceed 100 crore rupees in the previous year. Okay. The law wants to give an exemption to the startup who is in the growing stage, who are growing their business. If your turnover has already crossed 100 crores, then you are actually no more a startup. Now you are established organization. So that's why this third criteria is there. The total turnover should not be more than 100 crores in the previous year. Okay. And then fourth is this, you should have been certified as a startup by a government entity. Government has actually created a board, that board gives a certificate that this is eligible and this is not eligible. Income Tax Act doesn't define further who will be eligible. If you are having a certificate from the board appointed by the government, a separate department of government is there. So that department certifies you as an eligible startup. For income tax purposes also, you are eligible startup. You can claim this exemption under section 80 IAC. So these are four conditions further which are required to be fulfilled by any startup for claiming this exemption under section 80 IAC. Okay. So now we can develop a complete picture of this ATIAC. What is the requirement? I should be an eligible startup that is certified by this government board. Then I can claim this exemption under this section. Any 3 years within the first 10 years of my incorporation, any 3 years, I will be entitled for this exemption. 100% of my profits shall be entitled for exemption, provided my turnover does not crosses that 100 crore limit, and I have been incorporated on any date between this April 16 till March 21. Okay, this is all section 80 IAC. First, this deduction we are discussing with respect to income-based deductions. Okay, fine. Before we move forward, next section, a simple small 180 double J double A. Let's have one more query here. Okay. Fine. The query of Remya, for the benefit of everybody, I will not be reading the query in detail. I will be just giving the gist of it. When the section says the business should be a new business, that means it should not have been formed by revival or splitting of any existing business. If the business has been closed down due to any natural calamity, due to any reason beyond the control of the assessee, and then if the same business is revived, that is treated as a new business. Then we will not say it was an old business which you are reviving now. I was already running a business, it has been closed down due to any natural calamity. Say example, the very obvious example nowadays is because of all these pandemic issues, the business has been closed down, and then you revive it again. This will still be treated as a new business. The deduction would be available. The eligibility to claim deduction would be there. Okay. Any further question on this? Okay. Next section, this is something very simple, very small one. 80 double JA. Profits from the business of collecting and processing biodegradable waste. Okay, an environmental, say, incentive kind of thing. Collecting and processing biodegradable waste. Okay. Now, what the section says, assessee is engaged. Okay, and before this, we have one more query related with ATISC. Okay. This Muthulakshmi from Madurai. In the case of ATISC, the turnover of 100 crore limit applicable to whole 10 period available for exemption. Okay. See, this 100 crore turnover, we will be seeing with reference to that previous year in which I am claiming the deduction. In the year in which I am claiming the deduction, if my turnover is more than 100 crore, then I cannot claim that particular deduction. Okay. Next year, my turnover goes down 100 crore. I can claim the deduction next year within that period of 10 years. Okay. So it's an year by year situation. For the year for which you are claiming the deduction, you need to refer to that 100 crore limit. Okay. Yeah. Fine. Now this simple one, 80 double JA. What exactly is this section? Assessee engaged in the business of collecting, processing, or treating biodegradable waste. So what my assessee is doing? Assessee is in the business of this waste collection and the processing. He is collecting the waste, and then he is processing or treating this biodegradable waste. Okay. then 80JJA deduction would be available to the assessee. Okay, 100% of the profits for this business would be allowed as a deduction. Plain simple. Whatever are your profits, 100% would be allowed as a deduction for a period of 5 consecutive years. Simple one. But again, in the simple section, we need to see something very carefully, a minute understanding, what we call reading between the lines. At the final level, this minute hidden issues are something sometimes very, very important. Okay. So first thing is this 5 years period. In ICAI also, we have talked about 3 years period. So these exemptions are not available on a lifelong basis. They are available for limited period of time. ICAI 3 years, JJA 5 years. But I hope you are able to understand, you are able to see a very, very important difference between this period. In ICAI, this was 3 years within first 10 years. So it may be actually 8th, 9th, and 10th years also. JJA, there is no such flexibility. JJA, straightforward first 5 years. In the year you have commenced the business, first, second, third, fourth, fifth, eighth. You may have profit, you may not have profit, that is your problem. So JJA, it is the first 5 consecutive assessment years. Okay. So in order to take the benefit of this section, you have to generate profit from the first year itself. Otherwise, you won't be actually getting the benefit of it. Okay. So this is the first very important point related with JJA. There is no such flexibility here of a first 10 years any 5. It is first 5 years you can claim the deduction. Second is the nature of activity. Let's see it more carefully. What exactly is the activity which will give you a deduction under this particular section? Okay. Now see very, very carefully what the terminology law is using. They are talking about collecting and processing or treating. So if you are able to get it, they are actually combining 2 different activities. One is collecting and second is processing or treating. Processing or treating is a kind of synonymous. It is one and same. So there has to be a collection and then there has to be a processing of biodegradable waste. I am entitled for this JJA only when I do both of these activities. There might be a possibility that there is one entity who is collecting the waste from whole of the city and then it is handing over to somebody else and that other entity is processing it. Both cannot claim the deduction. I should be doing collecting and then I should be doing processing also. That and is very, very important. Now, at final level, you need to develop that minute observation. Every single word have its own significance. Are they saying collecting or processing? If they would have used collecting or processing, then I'm only doing collecting, I would be eligible. I'm doing only processing, I would have been eligible. But they are saying collecting and processing. Okay, so that and needs to be used, needs to be read with a microscope, needs to be read very, very carefully, needs to be underlined, needs to be highlighted. Collecting and processing, both these activities, if my assessee is doing, then only JJA deduction would be available. Okay, plain and simple. Otherwise, no calculations are involved in this section, but the conceptual clarity is important. Fine. So simple JJA. New section ATM. Okay. New section applicable from this assessment year, that is AY 21-22 onwards. And as I have just said, may attempt, amendment attempt. So all these new amendments are required to be read with double alertness, with say much more attention kind of thing. ATM, deduction in respect of certain intercorporate dividends. Okay. Let me give you the background of this section that will help you to generate a say connect with that particular section directly. Okay, for examination purposes, this mental connect with the section is something very important. By reading the information, you need to develop that connect. Okay, this information in the question, and your mind should tell you, okay, this provision would be applicable. So in order to develop that connect, you need to see the sections from all different angles. Okay, the background of it, why it has been introduced, what exactly it says, what was the logic, and then all those things would help you to develop that complete friendship with that particular section. Okay, so let's try to develop a dosti. Let's try to develop a friendship with this section. ATM, deduction in respect of certain intercorporate dividends. What is the background? If you have to develop a friendship with somebody, you need to know who is this person, what is his say background kind of thing. So what is this background? Now you all must be knowing it. Till last year, that is till financial year 1920, dividend received by a person used to be tax-free in the hands of shareholder. Okay, companies used to pay a dividend distribution tax on whatever dividend they were distributing in the hands of shareholder. Dividend received used to be a tax-free income till financial year 1920. From financial year 2021, that is assessment year 21-22, relevant for your examination, that the dividend received by a person has become taxable in the hands of receiver, has become taxable in the hands of shareholder. This is the clarity we all should be having. Now let's take this concept little bit further. We all are student of chartered accountancy. We know corporate structure, companies, etc. in a very clear-cut manner. So now let's try to generate this concept of taxability of dividend. Let's try to relate it with a company. Now there is a company which is having a subsidiary company. Now the subsidiary company has declared a dividend. So obviously holding company would receive this dividend. This will be treated as taxable income in the hands of holding company. Now holding company would be further declaring dividends to its shareholders. In the hands of shareholder, that dividend would again become taxable. Now you can see there is a common thread. The dividend which has been declared by the subsidiary company, it has been received by the holding company, and then the same dividend has been paid by that holding company to its own shareholder. Now that dividend, when declared by subsidiary, it has become taxable in the hands of holding. When holding declares a dividend, then it becomes taxable in the hands of shareholder of holding company. So in a sense, the same income is getting taxable again and again and again. So to break this cascading impact, to break this impact of same dividend getting taxable again and again, the section ATM has been introduced. The logic of this ATM, okay, the background of this ATM. If you get that background clearly, understanding language becomes little bit easy. What is the message the section is trying to give you? If that idea is clear, then the meaning becomes relatively simpler. Okay. So a subsidiary declaring a dividend to holding, holding declaring a dividend to its own shareholder. Normally, the same amount will become taxable at two times, in the hands of holding and then again in the hands of shareholder of the holding. Now let's see what section 80M is providing in this respect. Okay. So ATM is deduction in respect of intercorporate dividends. Basic idea is this. What is this intercorporate dividends? Okay, one company receiving dividend from another company. Intercorporate dividend. Dividend payer is obviously a company. Dividend receiver is also a company. ATM. So idea is this, why this whole discussion is important, what help this whole discussion would give you. In examination, if you have been given a question regarding calculation of income with respect to a company. Okay, now a P&L account of that company has been given. In the P&L account, credit side, there are number of income One of the income is dividend received from another company. Now, if that ATM connect has been developed in your mind, the moment you will read that a credit amount in the P&L account, dividend from other company, a tick will generate in your mind. Your mind will give you an alert that, okay, this company has received dividend from another company, ATM deduction may be available. Examiner will not tell this thing in the paper. Examiner will not write in the paper that, okay, please calculate ATM deduction also. If they start writing this, DTL becomes, say, the most easiest subject, but they don't write it. You needed to pick this from the question. The moment, okay, so from now onwards, the moment you will see the P&L account of any company, in the credit side, if you find any dividend received, ATM should start popping up your mind. ATM may be available, may not be available later on, but then you should become alert about that possibility that my company has earned dividend from another company. ATM might be applicable here. Okay, this is the first thing which is not written in the act, but which is important from an examination perspective. So if you are able to get that particular connect, then only ATM would be relevant for you. In the examination, nobody is going to you and tell you that, okay, ATM can also be considered here. Your mind should only tell you this thing. So if you are able to get this thing that, okay, I need to find out whether ATM deduction is available or not, then what are the rules, what are the provisions related with this ATM deduction? Let's see it. So this ATM deduction available to an Indian company, domestic company, okay, because we are talking about intercorporate dividend, we want to help our Indian company, so it is available to a domestic company, available for income by way of dividend received from any other company. This company has received a dividend from any other company or from a business trust. That business trust is a very exceptional situation. So you may as well say ignore it also. You may dilute that one also. Keep in focus this dividend received from other company. So I am XYZ Private Limited. I have received a dividend from ABC Private Limited. Okay. I can claim an exemption with respect to this dividend. Okay, so I have received a dividend from any other company. I can claim an exemption with respect to this dividend which I have received under section 80M. How much is the amount of exemption? Now this is simple. Calculation is not having any kind of problem. How much is the exemption available? Whatever dividend I have received or the dividend which I have distributed to my shareholders, whichever is lower. I have received 50 lakhs as dividend. I have distributed 30 lakhs as dividend. 50 or 30, whichever is lower, 30 lakhs would be the ATM deduction available to me. So simple. Calculation does not have much of the problem. But one thing we need to see with respect to that calculation, that amount of exemption received by me and distributed by me, whichever is lower. This distribution can be done up to 1 month prior to the due date of filing of ITR. 1 month prior to the due date of filing of ITR, okay, not necessarily in the same year in which I have received. I will be receiving it somewhere between the financial year 2021. My own dividend, which I have distributed till the 1 month prior to due date of filing of ITR for this FY 2021, that will be somewhere in the month of September, October 21, till a date of whatever dividend I have distributed, I can claim a deduction under section 80M. So calculation wise, it is simple. The only one point you need to keep in mind is the dividend distributed. Up till when this dividend can be distributed? 1 month prior to the due date of filing of ITR. Whatever dividend distributed, that amount, or whatever I have received, that amount, whichever is lower, that is the deduction under section 80M. Okay. So calculation is not a problem. But I'm again repeating, with all my experience of so many years with the students and examination, the real problem is never in the calculation. The real problem actually is creating that connect in the examination. Within that 3 hours time, it should come to your mind that, okay, ATM deduction is also to be calculated in the question. And they will not tell you anything in the question. They will not give you a single hint that there is something called ATM applicable. And in number of cases, this happens the moment you come out of the exam hall, it clicks. Oh, ATM was also applicable there. And the whole purpose is this click should come within those 3 hours only. Okay, so this is something very interesting, very important. These all are automatic deductions. Section will not tell you that you have to do this. They will simply give you a P&L account. P&L account will contain something as a dividend as credit. You will be including that dividend income for the purpose of calculation of your gross total income. Then there at that point, it should come to your mind that, okay, the dividend income has been received by the company. ATM is also available. I should look for the further information in the question, whether the question is talking about any dividend distributed by the company. Yes, then ATM deduction would be available. Okay, so the idea would be, the whole purpose of this today's discussion would be, today onwards, whenever you see a P&L account of a company and in the credit side you find something as a dividend income, the first thing which should come to your mind is ATM. Section ATM of the income tax, any dividend received by a company, this deduction would be available. This deduction may be available subject to that dividend distributed by the company. Okay, so this is about plain and simple ATM, ATJJ and ATM. These two are very, very simple kind of sections. If that basic conceptual clarity is there, then no further calculation level complications are involved. Okay. Any questions on this? I hope I'm able to convey the idea to your mind. What actually is required. ATM section you can read anywhere else also. But that connect clarity is something which you need to learn from here. Any questions on this? Anybody writing a question? Okay. So let's move to next section. Section 80P, 80JJA in between. We have skipped a separate section, detailed discussion we shall be doing later on. First, we are covering all these income-based deductions. Okay. So 80JJA, that biodegradable waste, ATM is in respect of my dividend income. Now this is 80P. Okay, deduction in respect of certain income of cooperative societies. In the hands of a cooperative society, income from certain activities are fully exempt. So this section 80P is a deduction available to a specific kind of assessee, that's a cooperative society. Okay. So in the books in the institute module, there is a separate chapter of assessment of entities. In that particular chapter, when they talk about cooperative society, they discuss this section 80P. So that ATP can be studied along with assessment of entities. It can be studied along with this deduction of income also, deduction from income also. We are discussing it here itself. Okay. Deductions from gross total income, income based deduction, ATP. Assessee is a cooperative society. Okay, so only for cooperative society this section is relevant. In examination, the moment they give you information about the assessee is a cooperative society, ATP should immediately pop up in your mind. If assessee is anybody else other than cooperative society, ATP has got no relevance. Okay. Yeah. So what is the idea? Again, at a calculation level, section is simple. No calculations are required to be done. No percentages are there. No whichever is higher, lower kind of thing. It's simple. Certain types of income and these income are fully exempt. Okay. One question before this, Padmanabhan from Trivandrum, ATM, is it a one-time deduction? No, Padmanabhan. This is an year-by-year basis deduction. There is no time period involved. Every year your company receives dividend and your company distributes dividend. Further, you can keep on claiming this ATM every year. Okay, not a one-time deduction, lifelong. Every year you can claim it. Okay. So now we are talking about this ATP cooperative society. As I was saying, calculation not an issue with respect to this section. It is simply different types of income. What needs our focus is the exact nature of the income. What exactly pinpointedly is the type of income which will be exempt. It simply lists out 5, 7, 10 different types of income. If the income given in the examination is exactly same what we are discussing here, then it will be 100% exempt. What is mentioned here and what is given in the question, if there is a slight difference, then the exemption would not be available. So what you need to see very, very carefully is the exact nature of the income which is exempt. If it is exempt, it is fully exempt. As I was saying, no percentages, no calculation, nothing is involved. Exact nature of income, that is what you need to focus on. Okay, so first activity, the income from all these activities are fully exempt. So first activity is income by way of business of banking or providing credit facility to its members. There are lot many credit cooperative societies. Okay, they take deposit from their members, they provide loan to their members. So this whole business of banking or income from providing credit facility to its members, income from this particular activity would be fully exempt. Okay, what needs to be kept in mind? Starting itself, we can generate this clarity also. The exemption is not to the assessee. The exemption is to the particular activity. Same assessee deriving income from this activity and also deriving income from other activities. Income from this particular activity will be fully exempt. Income from other activities, that is not exempt. Okay, so what exactly is the activity which is exempt? That is providing credit facility to its members. Income from that particular activity fully exempt. First. Second activity, cottage industry. Any cooperative society running a cottage industry, income from that cottage industry would again be fully exempt. Okay, say for example, in this city of Tamil Nadu called Sivakasi, this whole firecracker industry is there. Cottage industry kind of firecracker manufacturing happens. A cooperative society has been formed where say all the persons have joined, and in the form of a cottage industry, they are doing that particular activity. Whatever income that society would be earning, fully exempt, 100% exempt under ATP. Okay. Third, Marketing of the agricultural produce grown by its members. So here what the cooperative society is doing, there are agriculture produce grown by its members. Now this cooperative society is marketing this agricultural produce. 100% income is exempt. Okay. Now, what I was saying, the exact nature of the activity. So this third is a very good example. Again, how to read it, how to get the crux, what should get my focus. Institute has created a question specifically on this particular single line. They have created a question. So what exactly is the idea? Marketing of the agricultural produce grown by its members. What exactly is the activity we are talking? There is a cooperative society, all its members, now we can assume they all are farmers, they are growing agricultural produce, and then the cooperative society is marketing this agriculture produce. Whatever profit cooperative society is earning, that is not taxable. What is required? What you are marketing should be the agricultural produce. Say, for example, farmers have grown sugar cane in the field, and that sugar cane has been converted into sugar, and that sugar is being marketed by the cooperative society. Are you marketing agricultural produce? No, you cannot claim an exemption. So what is being marketed should be an agricultural produce. The exemption is very, very specific. Every single word is important. So what should be the activity? It should be marketing. Marketing of what? Agricultural produce only. Any other thing, what you are marketing is not an agricultural produce, exemption is not available. So it should be marketing, marketing of agricultural produce. Which agricultural produce? Which is grown by your members. Okay, say for example, traders have formed a cooperative society. They are purchasing agricultural produce, they are purchasing rice and wheat from the farmers, and then in their agriculture, in their cooperative society, they are marketing these agricultural produce. Whether this cooperative society can claim the exemption? No. It should be an agricultural produce grown by my members only. So three aspects, three things interconnected with each other. The activity should be of marketing. Marketing should be of agricultural produce. Agricultural produce should be grown by my members. All these three conditions fulfilled, exemption available. Any one condition is not applicable, any one condition doesn't fulfill, the exemption is not applicable. Marketing, agricultural produce grown by its members. Okay, fine. Okay, again, we have a query from the Trivandrum with respect to this credit facilities. Is income from Chitti Kuri's lowest bidded auction loan is exempt from tax under section 80P. Okay. Padmanabhan, I am not exactly able to understand the kind of business you are talking, but what I can say, if it's a business of providing credit facilities, in whatever manner you are providing credit facility, that is not material. What you are doing is providing credit facilities to the members. What is the modus operandi of this credit facility? What is the mechanism? I'm not interested. The law is not specifically talking about it. Law is saying if you are providing credit facility to the members, then the income is exempt. This credit facility you may provide in any manner. That is different. That is not relevant. Okay. So marketing of the agricultural produce grown by its members. Okay. So third activity, which is eligible for this exemption in the hands of cooperative societies. Okay. Ambika, sir, can manual processing, okay, Ambika from Mumbai, you need to say, phrase your query, what exactly you want to ask. And similarly, Sumit from Mathura, what exactly is your query? You need to rephrase it. Okay, Sumit from Mathura, ATP is the specific deduction available for cooperative societies. Other sections also, they may claim the deduction. If other sections are also applicable for them, they can claim the deduction there also. Okay, but ATP is specifically for the cooperative societies. So third activity, which is exempt with respect to cooperative societies. Okay, then the fourth one. Purchase of agricultural implements, seeds, livestock, or other articles intended for agriculture for the purpose of supplying them to its members. Fourth is, in a sense, opposite of third. In third, you are marketing. Your members are producing something and you are marketing it. In fourth, you are buying something and distributing amongst your members. Okay, so what you are buying? Agricultural items, seeds, livestock, other articles intended for agricultural purposes. The idea is this: farmers, rather than buying these items on an individual one by one basis, they should buy it collectively. We all know principle of economics. If you do a bulk buying, collective purchasing, you have a bargaining power. Okay, so in order to provide that bargaining power to the farmers, this concept has been created. Cooperative society may purchase these items in bulk and then they may supply it to the farmers, to their members. In the process, if any profit is made by the cooperative society, that will be exempt 100% under section 80p. So what you are purchasing, it should be items related with the agriculture, and then you are supplying it to your members. If you are selling it to outsiders, then exemption is not available. You are selling it to your members only, then exemption is allowed. Fourth. Fifth. Now, processing without the aid of power of the agricultural produce of its members. Now, what you are doing? In third, you are marketing the agricultural produce. In fifth, you are processing. Members have produced agricultural items and you are now processing it. The cooperative society is processing, but this processing happens without aid of power. Now, practically speaking, nowadays doing anything without of power is probably not feasible. So the provision may not have much of the relevance in the current scenario, but still it is there in the law. The cooperative society processing without aid of power the agricultural produce of its members, then this income would also be exempt in the hands of cooperative society. Okay, fifth. Next one, labor cooperative society. Okay, collective disposal of the labor of its members. Now, this is a cooperative society which is having all laborers as its members, and then their wages are being determined by the cooperative society. Cooperative society is collecting the wages and then distributing amongst the members. In the process, some profit is earned by the society, fully exempt. So, collective disposal of the labor of its members, full exemption is available. Okay. Last in the series, fishing or allied activities. Okay. Now this is fishermen's cooperative society. So we have talked about farmers cooperative society, laborers cooperative society, credit cooperative society, cottage industry cooperative society, and then this fishing cooperative society. Any cooperative society earning income by way of fishing or allied activities, that income is also fully exempt. So the first case of this section ATP, these 7 different types of activities run by a cooperative society, income earned from these 7 activities fully exempt in the hands of cooperative society. Okay. Again, we have a question. Okay. Remya from Tirunananthapuram, a very interesting question. If agriculture produce of members are processed without using power and then marketed, will exemption be allowed? Yes. If you are processing it without aid of power, then the exemption is available, and then you are marketing it, the same thing which you are marketing, the exemption would be available in this case. Okay, Sumit from Mathura, interest on deposit with any other credit society. This is coming. We will be discussing it later on. Okay, so this is the first 6-7 types of activities. Income from these activities fully exempt. What we need to keep in mind, I have mentioned it already, the exact nature of the activity. It should be marketing of agriculture produce grown by the members, then the exemption is available. It should be income by way of providing credit facility to its members. Okay, just to give you a real life example, how it creates a difference. Okay, there is this cooperative society which is providing loan to its members, credit facility. The same cooperative society is having safe deposit lockers also. We all know safe deposit lockers which are rented out. Now these lockers have also been rented out to the members. Loan has been given to the members, interest has been received, and then the locker rent, locker charges have also been received. It's a real life case. Income tax department took an objection that locker rent is not eligible for exemption. Matter traveled up to the courts, and courts have also ruled in the favor of department that what is exempt is the activity of providing credit facilities, providing the safe deposit lockers, charging rent for them. This is not covered here. You might be doing this activity along with your main activity, but law is very, very specific. That particular activity income is eligible for exemption. Any other income you are generating might be related with your main activity, but that is not eligible for exemption. Okay. Okay. Yeah, Padmanabhan from Trivandrum. Now, I will not be reading this query, but again, for the benefit of everybody, the clarification is important. See, whenever law talks about exemption to an income, that means that income calculated as per the provisions of Income Tax Act. So as per Income Tax Act, you mean income that is after adjusting all the expenditure. So Padmanabhan and all others, whenever the exemption is available, that is available to what we call in the accounting terminology is the net profit, not the gross receipt. So whatever is my activity, income minus expenditure, what remains, that will be eligible for exemption. Okay, Padmanabhan, I think you got your answer. Fine. Let's continue. This ATP has got something more remain. So these are 6-7 kind of activities. Income from these activities are fully exempt. Then following other income are also fully exempt in the hands of a cooperative society. Okay, Sumit from Mathura, your answer here. One cooperative society earning interest or dividend from other cooperative society. One cooperative society has deposited some money with other cooperative society and earning an interest. So that interest, that dividend is exempt for all cooperative societies. Now we are not talking about activity here. We are talking about income here. Earlier slide, we have talked about particular activity. Now we are talking particular type of income, interest or dividend received from another cooperative society, fully exempt for all cooperative societies. Now here in which activity I am, in which business I am, that is not important. If this is the nature of income, that is exempt for all cooperative societies. Okay. Then second income is any income derived by cooperative society from letting of godowns or warehouses. Now, this cooperative society has built certain godown, certain warehouses for the storage, processing, of facilitating the marketing of commodities. Okay, I'm storing, processing, of facilitating, marketing of commodities. So any income derived from this particular type of income, that is also fully exempt. Okay, godowns or warehouses are being rented out for marketing of commodities, storage, processing, or marketing of commodities. Then this activity is also fully exempt. Okay, then these are certain activities, these are certain income which are fully exempt. Apart from this, whatever remains, that is taxable. So for that taxable income, now there is a basic exemption which is further available. What is that basic exemption? In the case of a consumer cooperative society, a basic generalized deduction of rupees 1 lakh shall be further allowed. And in case of any other society other than consumer cooperative society, a basic general deduction of 50,000 shall be allowed. Whatever is exempt, that is exempt. Whatever remains, whatever income remains taxable, that income shall be taxable only over and above this 1 lakh or 50,000. A generalized exemption for a consumer cooperative society 1 lakh. In any other case, it is 50,000, which is the deduction available. The last point related with this section 80P, all these provisions are not applicable for the cooperative bank. Now, there are a number of banks, cooperative banks, which are banks, but which are registered as a cooperative society. So they say that we are first a cooperative society, then a bank. We should be allowed this deduction. Law has said very, very clearly that in respect of a cooperative bank, all these deductions would not be available, except, but the bank will not include this primary agriculture credit societies, what is called PACS, primary agricultural credit society, or this rural development bank. They will be entitled for ATP deduction. All other cooperative banks, ATP deduction would not be available. Okay. Fine. So this is about this section 80P, deduction in respect of cooperative societies. Something related to this 80P is the next section, section 80PA, farmers company, producer company. But I think at this point of time, we can take a quick break. After the break, we will reassemble and then we will take this discussion further. A quick, sharp, exact 15 minutes break. This is 19:26, 7:26 in my watch right now. So we will reassemble again exactly at 7:41. Okay, sharp 15 minutes break. Okay, see you after the break. Okay, thank you. Yeah, welcome back. I have received one query from Uma Rajamundri. Uma, please send this query again at the end of the class. This is something related with our last class discussion. I will answer it after the class. Please resend it. Uma from Rajamundri. Okay. Ambika from Mumbai, I'm not able to get your query clearly. Please resend it. Please rephrase it. What exactly you want to ask? Okay, please do it again. Fine. Meanwhile, we move forward. Remaining deductions under Chapter 6A, deductions from gross total income. Before the break, we have discussed about Section 80P, cooperative society, various income of cooperative society, exemption was available. Number of exemptions were related with the agricultural activities. So with respect to agricultural activities, with respect to farmers of the country, another deduction which is available, that is under Section 80PA. Okay. So what is this 80PA? Who can claim this deduction? First is who is eligible, the type of assessee, who can claim it. The deduction is available to a producer company, a very, very specific entity again, a company, but which is a producer company. And this producer company, which is having a turnover of less than rupees 100 crore in any previous year. In any previous year, turnover should be less than 100 crore. You should be a producer company. Now, what do I mean by producer company? No definition in the Income Tax Act. It has been defined in the Companies Act. Okay, Income Tax Act still refers to Companies Act 1956. Now this is Companies Act 2013. So defined in the Companies Act, the producer company, that is what is the producer company for income tax also. Okay, the requirement of income tax, my requirement is this, that your turnover should be less than 100 crore. Okay, if you fulfill this condition, if you are eligible, then 80PA deduction you can claim against which income? Two or three types of businesses are there. Again, marketing the agricultural produce grown by the members, purchase of all those agriculture implements for the purpose of supplying to the members, and then processing of the agricultural produce of the members. Here, this processing may even be with the aid of power. For cooperative society, it was without aid of power. Other two activities are exactly same. So now these three activities, you do it through cooperative society, that marketing of agricultural produce, purchase and distribution amongst the members of agriculture implements. You do it through cooperative society, you get exemption under 80P. Same activity done by a producer company having a turnover of less than 100 crore, then that income is exempt. Income from that activity is exempt under Section 80PA. So at a practical level, from the angle of market, from the angle of say farmers, now the same activity they can do by forming their own cooperative society, or they can do by forming a producer company, and then whatever income this society or company would be getting, that income would be 100% exempt. Okay, with respect to this producer company, the another difference with the cooperative society, 100% of the profits are exempt, but this exemption is available only up to 24-25. Assessment year 24-25, till that period, this exemption is available. Okay, it may get extended later on, but as of now, the requirement is this. Cooperative society, that exemption is available every year, no limit, no restriction. Producer company, that restriction is only up to assessment year 24-25. Practically speaking, you cannot have this differentiation. Cooperative society getting it every year, producer company getting up to a particular period. So very well, probably by the time we will reach to this 24-25, government would be extending that particular deadline. But that is something separate. That's a political issue. As a student, we need to keep this thing in mind. Producer company exemption available only up to AY 24-25. Okay. Okay. So this is all about ATP and ATPA. We can see ATPA is somewhat similar to ATP. ATP is larger, cooperative society, various kind of activities exemption is available. ATPA only those agricultural related activities and income from these activities is eligible for exemption. Okay, fine. Now, before we move further, certain further queries I am having. Sivraj from Chennai. Okay, first question from Sivraj. Okay, Sivraj, keep it up. Which one is beneficial, HRA or AT-G? Okay, which one is beneficial, HRA or AT-G? And in both the cases, you are getting a deduction with respect to rent paid by you. Shivraj, that will be actually a case-to-case situation. You cannot have a say unified kind of formula. But very basic thing, first of all, HRA is available only when you are in employment. If you are a self-employed person having your own business, etc., then HRA is of course not there. Then the only option is this AT-G. Now, in case you are in employment and your employer is giving you an HRA, then you may decide whether to take an HRA or not to take an HRA, claim a deduction under AT-G, but that will be a case by case basis situation, depending upon the amount of rent you are paying, depending upon the HRA you are eligible, that the decision would be taken. Okay. Now Ambika from Mumbai. Now it's a complete question. Yeah. For section 80M, it is compulsory that dividend should be received or distributed before the due date. For ATM, is it compulsory that dividend should be received or distributed before due date? Okay. For ATM, we are talking about two types of dividend. One is the dividend which I have earned, and second is the dividend which I have distributed. Dividend which I have earned, that is my income, and that is included in my income. That will be included in my income based on my method of accounting. If I'm following mercantile system of accounting, it will get included on a due basis. Okay, so if it's a company, section ATM deduction is available only to a company. So whatever dividend this company has earned, whether received or it has simply become due, the dividend will get included in its total income. Now, the dividend which the same company is distributing to its own shareholder, that distribution must happen before the due date. The due date is 1 month prior to the due date of filing of ITR. So the distribution should happen by that particular due date. Whatever dividend I am earning, that should have been earned. That means it should have become due to me during the previous year itself. Okay. Now, with respect to this income-based deduction, we come to now next two sections which are applicable again only to individuals, AT-QQB and AT-RRB. Okay, one specific type of income, and for that specific type of income, the exemption is available AT-QQB and next section AT-RRB. Some issues are common in both the sections, so we can have a simplified understanding of both the sections together. First is AT-QQB, deduction in respect of royalty income of authors. Okay, again, who is eligible, what is eligible, and how much is eligible. Now, three basic points we have generated for understanding this whole deduction. So first is who is eligible, who can claim this AT-QQB eligible assessee. Examiner may ask the question at any of the aspect. He may create a problem for you with respect to assessee itself. He may create a problem with respect to income, or he may create a problem with respect to calculation. Okay, the amount of deduction. So you need to have a clarity about all the issues in the particular section. Now 80QQB available to whom? It is available to an individual. Now, if you simply keep in mind individual, you have all chances of getting into that examiner's trap. He will deliberately give you individual non-resident in India. ATC is available even for non-resident, but every section a separate story. You cannot apply their concept here. ATQQB individual resident in India. Only when my individual is resident, QQB he can claim. A non-resident cannot claim. Okay. Now, what this individual is doing? He is a resident in India. What he is doing? He is an author. Okay. Either a single individual author or a joint author. Okay. And he has authored a book. Which kind of book? Another important. Simply authoring a book is not sufficient. The book should be of a specific nature. It should be of a literary, artistic, or scientific nature. Okay. So CA Manish Dafaria has written a book on taxation. Okay, if I plan to write a book on taxation and I might feel that, okay, I will get an exemption under 80QQB. Unfortunately, income tax is neither literature nor art, neither a science. So I won't be getting a deduction. Okay. So book must be in the nature of literature, art, or scientific nature book. Okay. Now it should actually be a book. Book does not include brochure, commentaries, diaries, guides, journals, magazine, newspaper, textbooks, etc. It should be actually a book. It should not be a textbook for school. It should be a general reading book, literature, art, or scientific nature book. Assessee is an individual resident in India, authored individually or jointly a book which complies with all these conditions. Then story moves further. Then exemption can be claimed. What is eligible now? The income as an author. What kind of income? Either as a lump sum consideration for assigning or granting copyright in the book. He has written that particular book. He has given copyright of that book to some publisher, received a lump sum consideration. He can claim the exemption. Or he is receiving a royalty or the copyright fees in respect of such book. Okay, based on say actual volume of sale or something like this, he is receiving royalty or copyright. Then that is also eligible. And third is, in some cases, he may even receive an advance payment. Okay, for writing a book, I will be writing a book later on, but the publisher is ready to give me an advance. So even that advance is also entitled for this deduction. So a lump sum consideration for granting the copyright of the book, a royalty or copyright fees on the regular basis, or an advance payment, basically any income related with that particular book. I am authoring a book, and with respect to that book, any kind of income I am getting, 80QQB deduction is available. Who am I? I am an individual resident in India. Who, what is the income, how much? WWH. What is the amount of exemption? Whole of such income or rupees 3 lakhs, whichever is lower. Maximum deduction under 80QQB can be claimed up to 3 lakhs of rupees. Maximum 3 lakhs is the deduction available here. Okay, whole of the income or 3 lakhs. Now, here again, we would like to highlight that point which we have discussed earlier in response to a query. Whenever we talk about income eligible for this exemption, now that income means income after all expenditure. If this deduction would not have been there, how much income would have been taxable? Say, for example, now there is this author who has written a book, got a royalty of around 4 lakhs. For writing that particular book, he has incurred an expenditure of 1.5 lakhs. 4 lakhs is the income, 1.5 lakhs are my expenditure. How much is the taxable income? Obviously 2.5. Now, if 80 QQB exemption is there, what calculation I will do? 2.5 lakhs or 3 lakhs, whichever is lower, total 2.5 lakhs would be exempt. So whenever we talk about income, that means income after the expenditure. Okay, whatever are the expenditure which are deductible as per the act, all these expenditure have been deducted. What remains, that is my income, and that income is to be considered for all these calculations. So if a comparison is to be done with rupees 3 lakhs, that comparison is not with the gross income, that is with respect to the net income. Net income, that is after all the deductions. Okay, so if this deduction would not have been there, in our example, my taxable income would have been 2.5 lakhs. That 2.5 lakhs or 3 lakhs, whichever is lower, total 2.5 lakhs would be exemption. Okay, 80QQB. Fine. Now there is a limitation on this deduction. 3 lakhs is in any case the maximum ceiling, but apart from that 3 lakhs, there is one more limit, there is one more restriction. If my income is not a lump sum consideration, but it is based on the sale price of the books. Normally, whenever an author writes a book, the royalty which he gets is based on a percentage of sale price. Say for example 20% of the sale price. So if the book price is 200 rupees, for each copy sold, the writer would be getting 20%, that is 40 rupees. Okay, so if the royalty is by way of this based on the sale price of the book, then the law says the income before allowing any expenses exceeds 50% of the value of such book sold. Whatever is my gross royalty before expenses, whatever is my gross royalty, that is more than 15%, then excess will be ignored for the purpose of 80QQB. Whatever is the excess, that will be ignored for the purpose of 80QQB. Only up to 15% it will be treated as income from that particular book, and that much income shall only be considered for the purpose of this deduction. Okay, the excess over 15% of sale price, though it will be taxable, but for the purpose of this deduction, that excess over 15% of sale price shall be ignored for the purpose of this section, meaning thereby for the purpose of this 80QQB, that excess over 15% shall be treated as if it is something else, it is some other income, it is not my income from royalty. Okay, so if the total sale price, sale value of book is say for example 10 lakhs, the royalty which my assessee is receiving is at the rate of 25%, that is 2.5 lakhs. Law will say no, you are getting 2.5 lakhs, but we will treat you are getting royalty up to 1.5 lakhs only. Excess you are getting, that is your taxable income, but that is not in the nature of royalty. So that excess income shall not be considered for this 80QQB calculation. Overall ceiling 3 lakhs is always there, but apart from that overall ceiling of 3 lakhs, this is internal ceiling, one more ceiling, 15% of the value of such books. Up to that much amount, we will treat this as income from book. Excess over 15% is your income, but that will not be treated as income from book for the purpose of this section 80QQB. Okay. Similar kind of another section, another deduction, that is section 80 RRB. Deduction in respect of royalty on patents. Here again, my assessee is an individual resident in India and who is a patentee. Patentee, that means he has got a patent registered in his name. He is a patentee. Maybe a single patentee or maybe a joint patentee, but he is a patentee, individual who is a resident in India and he is a patentee. Got a patent registered in his name. He has done some invention, some new thing he has invented, and he has got the thing patent in his name. So he is a patentee individual resident in India. Now, what kind of income this person is deriving? Any income by way of royalty in respect of this patent. He has got a patent registered in his name. Then he is getting a royalty from other persons. Other persons are using this patent, and this individual resident in India is getting a royalty in respect of that patent. 80 RRB deduction he can claim. How much is the amount of deduction? Again, whole of this income or 3 lakhs of rupees, whichever is lower. Same limit which is there in 80QQB, same limit is applicable for 80RRB also, up to 3 lakhs or the actual income, whichever is lower, that is the deduction available under section 80RRB. Okay, fine. After discussing these various sections, deductions based on different types of income, then we come to another section, that is 80JJAA. Mind you, all these income-based deductions are included in Part C, Chapter 6A, Part C. That Part C word we will be using later on also. In this whole Part C, there are all these deductions, this ATQQB, ATRRB, earlier ATP, all these are Part C. There is the section 80JJAA also, which is included in the Part C. Though actually it is not based on my income, all other sections are based on my income. This 80JJAA is not based on my income, but that is also included in that Part C of Chapter 6A. So there are certain provisions which applies on the Part C as a whole. So all these provisions which we will be discussing later on, all these provisions shall apply even on 80JJAA also. But 80JJAA is not an income based deduction. It's a very different kind of section, a very different deduction is there, a little bit complicated and something very, very important also. Okay, so now let's try to see very, very carefully what this 80JJAA is all about. Again, I'm repeating, it has nothing to do with my income. We will not be talking about any particular type of income. It's a separate kind of, a separate nature deduction is there. Deduction in respect of employment of new employees. The baseline which we can keep in mind, that is deduction in respect of employment of new employees, 80JJAA. Now let's listen to that story very, very carefully. Some complicated provision. Earlier sections were rather simple. ATQQB, ATRRB, this type of income, this much is the deduction. ATP, this type of activity, 100% income exam, simple kind of thing. 80JJAA has got a good amount of complications involved. So see it carefully, read it very, very carefully. Who is eligible? Type of assessee. Who can claim 80JJAA? Very simple, any assessee to whom section 44AB applies, who is required to get his books of accounts audited under section 44AB, that assessee can claim deduction under section 80JJAA. So now we are not talking about type of assessee. We are not talking about individual, company, partnership, firm, LLP. We are not talking about a resident, non-resident. Simply section 44AB applies. This is the person who can claim deduction under section 80JJAA. Okay, so any assessee, if it's a partnership firm or even a proprietorship concern, 44AB applies. Tax audit is required to be done. 80JJAA they can claim. Even if it's a company, but 44AB does not apply, then 80JJAA cannot be claimed. So some very unique features are there in this section. So the first unique feature here itself we are seeing. All other sections talk about type of entity: individual, partnership, cooperative society, producer company. Here we are not talking about type of assessee. Assessee may be any type of entity. The requirement is this 44AB. If 44AB applies, you can claim 80JJAA first. Now, what is eligible for this deduction? And it's in a sense, it's a payment-based deduction covered in that part C related with the income-based deduction. But in a sense, it is linked with a particular payment. Okay. So what that particular payment is required to be done, what you have paid, emoluments paid or payable to the additional employees. Emoluments is a typical legal word. For the sake of simplicity, we can simplify it by reading it as wages, as a salary. So wages, salary, emoluments paid or payable to the additional employees. What is this additional employee? We will discuss. But then there are certain additional employees. To these employees, I am paying wages, I am paying salary, I am paying emoluments during the previous year. I am an entity covered under section 44AB. I can claim this deduction. How much deduction would be available? Whatever salary, whatever wages, whatever emoluments I have paid to this additional employees, 30% of these wages, I can claim the deduction in the first 3 years. First year in which this additional employees have been employed, and then second and third year thereafter, 30%. Whatever wages I have paid to these additional employees, for the sake of simplicity, we can treat these additional employees as new employees. Okay. So whatever salary or wages or emoluments I have paid to my new employees, 90% of the salary or wages, I can claim a deduction in 3 equal installments. We can read the section in this manner also. 90% of these wages, I can claim the deduction in 3 equal installments. 30% first year, 30% second year, 30% third year. Okay. 30%, I can claim as a deduction in 3 different years. So for example, emoluments of this additional employees, new employees in year 1 is rupees 100. In this year, I have paid 100 rupees to the additional employees. What will happen? I can claim deduction in year 1 rupees 30. I can claim deduction in year 2 again 30, and I can claim deduction in year 3 again 30. 100 rupees I have paid in the first year. 90% of it I will claim a deduction in 3 yearly installment, 30% 1 year, 30% second year, 30% third year. Okay. A very common confusion related with 80JJAA, we need to generate a clarity here itself. First year I have paid 100, I will get 30% as deduction. To the same employees, next year I have paid 150. So with the second year, my deduction would be 30% of 150, that is 45 rupees. No. Whatever salary I am paying to them in second and third year, that is immaterial. What is required? First year, whatever salary I have paid to these additional employees, to these new employees, 30% of the same would be allowed in the first year, second year, third year. This may create a very big confusion, and there is a confusion in the mind of lot many people that second year 30% would depend upon salary paid in the second year. No. And that's why it is better to understand, to read the section in this manner. Whatever salary you have paid in the first year, 90% of this shall be allowed as a deduction in 3 equal installments. So current year you have paid 100, 90 is the deduction, you will get 30, 30, 30 in 3 years. Okay. Now, who are my additional employees? The salary, the wages paid to them shall be entitled for this deduction. Now, these employees would be only those persons who fulfill certain conditions. What are these conditions? We will see later on. But before this, what is the emoluments? What are what is included in the wages for which the deduction would be available. Section says wages means emoluments means sum payable to an employee, does not include employer contribution to the provident fund, any retirement benefit. So employer contribution to the PF, for this no deduction is available under 80JJAA. Any retirement benefit, any gratuity, etc. I have paid, for this 80JJAA deduction is not available. Plain, normal, simple, whatever salary, wages, emoluments I have paid to these new employees, for this only this 30% deduction would be available. Okay. In respect of wages, emoluments, salary paid to the additional employees. Who are additional employees? Who fulfill certain conditions. What conditions? Now this is important. What is the idea? The connect which we can generate, my assessee covered and tax audit, he is paying wages to certain employees. If this employee can be treated as an additional employee, then with respect to these wages, I will get this 80JJAA deduction. So whether an employee would be treated as an additional employee or not, what does it mean? The first condition is this: he should be a new employee, should have been employed during the previous year. Then, because of his employment, total number of my employee should have increased. Whatever was the number of employee as on the last day of the preceding year, there has to be a net increase during the year. So for getting 80JJAA deduction, the basic requirement is this. Let's understand in this manner. For getting this 80JJAA deduction, the basic requirement is this: there has to be a net increase in the number of employees. If we are talking about financial year 2021, then number of employees as on 31st March 20, this number should go up. During 2021, I should have a net increase. As on 31st March 20, I was having 100 employees. Now there has to be a net increase over this 100. So my total number of employees should go up. Whatever was my number of employees as on the last day of the preceding year, that number should go up. Okay. Fine. Okay. Now this additional employee, this eligible employee will not include, it should be a new employee, it should result in the overall increase in number of employees I am having, but this new employee will not include anybody who is drawing salary more than 25,000. So higher level employees would not be considered here. We are talking basically about those employees who are lower or middle level employees, salaries up to 25,000 per month. Then only they will be treated as additional employee, eligible employee. Okay. An employee for whom the PF contribution is paid by the government. If this is an employee whose PF contribution is not paid by the employer but being paid by the government, then that will not be treated as additional employee here. For this employee, 80JJAA would not be available. Third is, if this employee has been employed for less than 240 days. This is important condition. There are other issues also related with this 240 days. We will be discussing later on. But right now, this should be an additional employee, new employee, minimum 240 days during the previous year. He must have been employed. Then only his wages will be entitled for 80JJAA deduction. And then any employee who does not participate in a recognized provident fund, whose PF deduction is not happening, then that is also not an additional employee. Okay, if additional employee words create a confusion, in our mind, we can treat it as an eligible employee also. Employee should be an eligible employee, then only his wages shall generate 80JJAA deduction. So who will be an eligible employee? Or who will not be an eligible employee? If his salary is more than 25,000 per month, he is not an eligible employee. He does not contribute to the provident fund, or his PF contribution is paid by the government, then also this is not an eligible employee. If he has been employed for less than 240 days during the previous year, then also he is not an eligible employee. So all these conditions are required to be keep in mind in order to decide who all are my eligible employees. What the section is calling additional employees. So who all are my eligible employees, who all are my additional employees. Now I have identified that, okay, these many persons are my eligible employees, are my additional employees. Whatever salary I have paid it to them, whatever wages, whatever emoluments I have paid it to them, total emoluments, 30% deduction in the current year, 30% in the next year, 30% in the third year, the deduction would be available. Okay. Now, there may be something interesting to this whole. Current year, my eligible additional employees, I have paid total wages of 1 lakh to them. So 30,000 deduction in the current year, 30,000 second year, 30,000 third year. Second year, again, I have got further additional employees. Whatever wages I have paid it to them, that will generate another series of deduction. So in the second year, I will be getting two deductions, one for the second year itself, one for the last year. In the third year, again, there may be further additional employees. So in third year, probably I will be getting total of three amounts as deduction. So this is how the things will move. Okay. Padmanabhan from Trivandrum. I think you have got your answer. Okay. So first year, 30, 30, 30. Second year, the new series may start. Third year, another series may start. So like this, the deduction will keep on happening every year. Okay. The employee should be an additional employee, should be an eligible employee. Okay. Additional word may create a confusion sometimes in mind. So for writing an examination, you can keep in mind additional employee, but for understanding purposes, you can keep in mind eligible employees. So all these conditions have been fulfilled. The person is an eligible employee. Salary paid to him would be entitled for 80JJAA deduction. Okay. Before we move to discuss other incidental clarificatory provision of this section, one more clarity is important. All these things which are, say, unnecessary kind of confusions in mind, we need to have clarity. Whatever salary I am paying to any employee, whether that employee is an eligible employee for 80JJAA or he is not an eligible employee, but he is my employee. So whatever salary I am paying to him, that salary is always allowable as a deduction while calculating my business income. And when I calculate my business income, the total salary paid, total wages paid to my employee, that is allowed as a deduction. So for that normal deduction, whether the employee is an eligible additional employee or not, that is not required to be seen. Whatever salary I have paid, I have already claimed a deduction. Now salary paid to these additional employees, to these eligible employees, that has also been claimed as a deduction against my business income. Same salary I am claiming a deduction under 80JJAA. This means that there is a double deduction available with respect to this eligible employees, additional employee. Full salary is already allowed as a deduction while calculating my business income, and over and above that normal deduction, this additional further deduction is being allowed to me. So it's a kind of deliberate double deduction being given by the law. Keep in mind this thing very, very clearly. Deliberate double deduction. The normal deduction is available from my business income. Any wages paid to my employee, that is a deductible business expenditure. So to this additional employees also, whatever salary, whatever wages I have paid, I have once claimed a deduction while calculating my business income. Now I have calculated my business income, I have calculated my gross total income, and now I am finding out how much deductions I can claim from this GTI. So at this stage again, the salary the wages paid to the eligible employee, I am claiming another deduction under 80JJAA. Okay, I hope I'm able to convey this thing with some kind of clarity. This is important for you to understand. If you are not able to get it properly, just thought over it, just ponder over it, but to get a clear picture, a deliberate double deduction being created by law. Okay, now come to certain further clarifications. We have seen one requirement of 240 days. In order to be an eligible employee, additional employee, the person should have been appointed for minimum 240 days. Anybody who has been appointed for less than 240 days during the year, he or she is not an eligible employee. Now, with respect to the 240 days concept, there are two clarifications. One is, if the assessee is engaged in the business in some specific businesses. What are these specific businesses? Manufacturing of apparel, of footwear, or leather products. If he is engaged in the business of manufacturing of apparel, footwear, or leather products, instead of the 250 days, 150 days is sufficient. In order to treat that employee as an eligible employee, additional employee, employment of 150 days is sufficient. Normally, person would be treated as eligible employee only when he has been employed for minimum 240 days during the previous year. But for these industries, even if somebody has been appointed employed for 150 days, this is good enough. He will be eligible. Now, another very interesting situation related with this. Somebody, say for example, this 240 days, a normal business, the minimum employment required during the year is 240 days. Now, just think practically, for the purpose of 240 days employment in the previous year, the person should have been appointed somewhere in the month of April, May, June, July kind of thing. Say for example, somebody has been employed somewhere in the month of November. Now in this year, he will not be able to complete 240 days. That means he will not be treated as an eligible employee. So then law says that if he has been appointed in the current year, he could not complete that 240 or 150 days, but then he is continuously in employment. Second year, he has completed his 240 or 150 days employment period. So in second year, he will be treated as an eligible employee. The wages paid in that second year shall generate 80JJAA deduction in second, third, and fourth year. So in the year in which he is employed, he completes that 240 or 150 days period. Then from first year deduction would start. In first year, the employee does not complete that 240, 150 days period. He completes this many days in the second year. His deduction would start from second year, second, third, and fourth year deduction would be available. So when an employee is employed during the previous year for the period less than 240 or 150 days, but he is employed for the period of 240, 150 days in the next year, he shall be deemed to have been employed in the succeeding year, and the provision of the section shall apply from the second year onwards. Okay. So this is what this 240, 150 days issue. Last part related with this 80JJAA, this deduction is not available. When it is not available, this we already discussed. There is no net increase. There is no increase in the number of employees from the total number of employees employed as on the last day of the preceding year. Okay. So one case, there has to be a net increase. If there is no net increase in the number of employees, then obviously this deduction is not available. Another requirement is this: if these wages, these emoluments have been paid otherwise than by way of an account pay check, account pay bank draft, or through banking system, through online or ECS system, then only these emoluments would entitle for this 80JJAA deduction. Simply speaking, salary or wages paid in cash or paid by way of bearer check, etc., 80JJAA deduction would not be available. Okay, the payment must be by way of check, account pay check, account pay bank draft, or through this net banking system, etc. Okay. Now another interesting question, there has to be a net increase in the employee, then only this deduction would be available. So if this is the situation, what will happen in the very first year? In the very first year in which the business has commenced, what will be the net increase in the employees? Law says all the employees employed during that previous year shall be deemed to be the additional employee. Okay. So if it's a new business, in the very first year, whatever number of employees you have appointed, all these employees would be treated as a new employee, and 80JJAA deduction can be claimed for them. This net increase requirement shall be treated as fulfilled, because last previous year 31st March my number of employees was 0. So whatever employees I have appointed during the year, it is a net increase. So all employees appointed during the year, in the case of first year of a new business, all employees appointed during the year who qualify this all other conditions, they will be treated as new employee. 80JJAA deduction can be claimed. Okay. Next issue related with this, some then theoretical procedural requirements. One we have discussed with respect to that startup also. The business should be a new business. Okay, the deduction is available only if it's a new business. It is formed by splitting up or reconstruction or revival of an existing business. 80JJAA is not applicable. Okay, but then this we already discussed. That if the business has been closed down because of any natural calamity, etc., any reason beyond the control of the assessee, and then it has been revived later on, then this will be treated as a proper new business. 80JJAA will be available. Okay. If the business has been acquired from other person, you have purchased some business as a going concern from somebody else, then you cannot claim 80JJAA deduction. And then unless and until you furnish a report of chartered accountant along with your return, you cannot claim 80JJAA. So for claiming 80JJAA deduction, the report of chartered accountant is also required to be furnished. Okay. This is section 80JJAA. Okay. A very large kind of section, good amount of complications involved. Some concepts may require a very minute kind of understanding. Okay. So you would be required to read it again, go through it again in a very careful kind of manner. Okay. Now, before we take up certain remaining issues related with this deductions from gross total income, any queries, anything regarding this 80JJAA? Padmanabhan from Trivandrum, I think I have answered this query also. An additional employee to be classified as eligible, should he compulsorily participate in RPF? Yes. An additional employee would be eligible employee only when he participates in a recognized provident fund. If he does not participate in RPF, his wages are not entitled for 80JJAA. Okay. Yeah. Any further query? Okay, fine. So after discussing these various income-based deductions, which are basically collectively called Part C deductions also. Now some important clarifications related with all these Part C deductions. all these income-based deductions and 80JJAA also, for all these Part C deductions, there are certain important clarifications. Okay. Given in the earlier part of the chapter, section 80A, AB, AC, etc. Deliberately, I have deferred this discussion. First, it is good to generate a clarity about what these deductions are. Then these related incidental provisions we can understand in a better manner. Okay. So now the first very important clarification. Okay. For claiming all these Part C deduction, it is very, very necessary that ITR is required to be filed up to the due date. You can normally file your ITR belatedly also. There is a provision, there is a mechanism. Section 139(4) allows even a late filing of return also by paying that extra fees, etc. You may file your return belatedly, but in that case, this Part C deduction would not be available. Okay, so this is first thing. What we need to further understand that with respect to chapter 6A, this is this whole Part C, income based deduction in 80JJAA. Apart from this Part C, there are other deductions also, all those payment based deductions, and then some deductions which we will be seeing later on, 80 TTA, TTB, 80U. This due date filing of return requirement is not there with respect to other deductions. Say, for example, my ATC deduction. If I have filed my return belatedly, whether ATC would also not applicable? No. This requirement of filing ITR up to due date is applicable only for Part C deductions. That's why it is very, very necessary to understand what all are the Part C deductions. Part C deductions are all income-based deductions plus 80JJAA. So 80IA to 80RRB, any section prior to 80IA up to 80GGB, GGC, from 80C to 80C, 80C to 80GGC, and then beyond 80RRB, that is 80TTA, 80TTB, 80U, which we will be discussing subsequently. All those deductions, return may be filed belatedly. These deductions are available. Only for Part C deduction, this requirement is there. ITR has to be filed up to the due date, then only these deductions will be available. Okay. Then the second requirement is this. In a sense, we have covered earlier also that whatever is the income eligible for this deduction shall be first computed as per the provisions of the Act, and then this income only shall be entitled for this Part C deduction. Okay, let me create a very interesting situation for you, a kind of tax planning. Now, I am an eligible startup. 3 years, my income is 100% exempt. I want to claim this exemption in the first 3 years itself. Okay. Or in any 3 years, I want to claim an exemption. So what I do, I feel that for this year, since my 100% income is exempt, I should not charge depreciation. I should not claim depreciation in income tax. What will be the benefit? If I will not claim depreciation right now, my WDV would be higher. So when my income would become taxable, I will be able to claim a higher depreciation. So I don't claim a depreciation today. My income will go up. Let it be. My 100% income is exempt. So that's why law says that you cannot do this. First, income is to be calculated as per all the provisions of the Act, as if these deductions are not available. The income is to be calculated as per all the provisions of the Act, and that computed income only, after allowing all these expenditure, deduction, everything, that computed income only shall be entitled for the deduction. Okay. Second clarification. Okay. This is important. Okay. What actually this third point is trying to say. Any transaction between business entitled for Part C deduction and any other business of the same assessee this transaction has to be valued on the basis of market value of goods or services involved. Okay, the transfer pricing provision, the arm's length price provision would be applicable here. Now, what exactly it is? Let's again try to generate a real life situation. Now, my assessee is having two businesses. One is eligible for this Part C deduction, another is normal business. Okay, so what I can do from my normal business, I sell something to this Part C eligible business. Okay, now, what I do, I deliberately sell that item at a lesser value. From my normal business, I sell the item at a lesser value to eligible business. What happens? Eligible business profit goes up, normal business profit goes down. I'm selling at a lesser price, so I'm booking lesser profit in normal business. In eligible business, I'm booking higher profit, but it's okay with me. Even if eligible business I am booking higher profit, 100% income is exempt. So what can be done by the assessee? They are having two businesses. They can play around with the things in such a manner that eligible business, which is entitled for this Part C deduction, that eligible business generates a higher profit, normal business generates a lower profit. To check this, it has been provided very, very specifically that whatever are the transactions between the two businesses of the same person, one is eligible for Part C deduction, other is not eligible, then these transactions shall be valued based on market value of the goods or services. The arm's length price provision would be applicable in this case. Okay. Then another important requirement is this, that if for any business Part C deduction has been claimed, then there is the section 35 AD of the income tax. This 35 AD shall not be applicable for any of the year. You are claiming this Part C deduction in the first year, 35 AD, you will be disentitled for life, never available. What is this 35 AD? If you can recall, business income chapter, section 35 AD, certain types of businesses where even the capital expenditure is also allowed as a deduction 100%. Normally for capital expenditure, you can claim depreciation. For 35 AD businesses, capital expenditure are also allowed as a deduction 100%. Okay, but now the law is providing that if you have claimed a deduction under Part C in any year, then 35 AD you will become debarred for whole of the life. 35 AD deduction cannot be claimed for any of the year. Okay, fine. Let's again take certain queries in between. Okay, this is very interesting query. Sumit Jain from Jaipur, again with respect to 80JJAA. What if employee which has employed in the first year have been left in the second and third year? Then deduction is available in second and third year. Yeah, it's a very, very common kind of query and good it has been asked. So the question is this, there is an employee who has been employed in the first year and we have paid a salary of 50,000 in whole of the year. All in totality, 50,000 salary has been paid to him. He's an eligible employee, additional employee. So 30% of that 50,000, 15,000 deduction we will claim in the first year, 15 in second, 15 in third. Now say for example, in second year that employee has left the organization. He is no more there. Whether still I can claim the deduction in second and third year. Now logically you may have a problem. So the employee is not there. So how I can claim a deduction for his salary? The point is this, and that's why we have talked in this manner. Whatever salary you have paid in the first year, 90% of that salary would be allowed in 3 equal installments. In second year and third year, whatever happens, that is immaterial. If a deduction has been generated in the first year, it will be available in second and third year. So in second year, the employee's salary may go up, still the same deduction would be available. Second year, employee salary may go down, still the same deduction would be available. In the second year, employee may leave the organization at all, still the same deduction which we have claimed in the first year, that will be available. Okay. So in second and third year, no further conditions are required to be seen. For the second year, if you want to start new series of deduction, then you need to find out in second year who all are new eligible employees. But first year deduction you have claimed, the same deduction is available in second and third year also. In second year, salary may go up, may go down, employee may leave the organization, nothing makes a difference. Okay. Fine. So this is these are some important clarifications related with this part C, section 80A, AB, AC, all these different sections talk about these various important clarifications. Okay. Now the last part of our discussion, certain other deductions. Okay. Payment based deductions we have covered, then all these part C deductions we have covered, and then after part C these are 2-3 further deductions. Basic clarity, these are not part of part C, so that filing of income tax return up to the due date requirement is not applicable for these 3 deductions also. This requirement is not applicable for all payment based deduction. This requirement is not applicable for these 3 deductions also. They are beyond part C. Okay. So now these 3 sections, simple enough. Okay. All these 3 are something very simple. 80 TTA and 80 TTB. Again, what we will be doing in the books, you will find these 2 sections discussed separately in a one-by-one manner. But from examination perspective, it is important to develop a combined clarity about these sections so that you will be in a better position to apply these provisions in examination situation. Okay, they talk about more or less similar kind of situation, so it will generate a better clarity, saving of time also to discuss them in a combined manner. 80 TTA, 80 TTB. Okay. First exemption which is available in the case of an individual, non-senior citizen, or in the case of an HUF. Interest on savings bank account. So any individual who is below 60 years of age, or in the case of an HUF, interest on a savings bank account with a bank or post office up to 10,000 rupees deduction is available. This is 80 TTA. So deduction is available to an individual less than 60 years of age or to an HUF. What is the income for which the deduction is available? That is this savings bank account interest. The savings bank needs to be underlined. Interest on a savings bank account. Amount of deduction 10,000. 80 TTA. Then come to 80 TTB. This is available for the senior citizens. Okay. Senior citizens, that is individual resident in India, age is 60 years or more. Okay. Senior citizens. Interest on any deposit, deduction up to rupees 50,000. Why it is good to have a combined study of both these sections, to see both these sections in a combined manner in order to appreciate the difference between this income eligible for deduction. In the case of 80 TTB, interest on any deposit is eligible for deduction. In the case of 80 TTA, only savings bank account interest is eligible for deduction. What does interest on any deposit means? It means savings bank account interest. It means even FD interest also. So now the question is this, for me, an individual who is less than 60 years of age, whether the FD interest from a bank is eligible for deduction? No, because I am covered under 80 TTA. I can claim only savings bank interest as a deduction. If I am covered in 80TTB, then I can claim interest on any deposit. I can claim even FD interest also as a deduction if I am covered in 80TTB. But for getting covered in 80TTB, I should be a senior citizen. Okay, so that's why these two sections create a good amount of confusion, particularly 80TTA, whether FD interest, because that is also coming from a bank, whether that bank FD interest is eligible for exemption. If I'm covered in 80TTA, only savings bank interest is deductible. If I'm in 80TTB, any interest from bank is deductible, including FD interest. And that's why in TTB, limit is high 50,000. TTA, it is only 10,000. Okay. So for senior citizens, savings bank interest and FD interest both are deductible up to 50,000. For non-senior citizen, only savings bank interest is deductible up to 10,000. For senior citizen, it is up to 50,000. Okay. Fine. And then the last part of our discussion, that is the section 80U, the last section, deduction available from gross total income. Okay, very interesting query. For 80TTA and 80TTB, interest has to be from a bank or from a post office. NBFCs are not banks. So interest from NBFC, neither 80TTA nor 80TTB, nothing is available. Okay, it has to be bank or post office. Every interest is not covered. So NBFC interest is not covered. Any personal loan kind of interest is not covered. Only bank or post office interest that is covered in 80TTA and 80TTB. Okay, and then the last piece of this whole discussion, deductions from gross total income, that is deduction for persons with disability, section 80U. Okay, who is the assessee? Individual resident in India. And in last class also I have given the suggestion, and again I am repeating it. In the time of examination, this will be a very big confusion, which deduction available to which type of assessee. So a very simple idea would be, today itself create a simple table, a one-page table focusing only on this aspect. Which section, which deduction available to which type of assessee, simply on this particular aspect. Okay, so this section, individual. This section, individual resident in India. This section, individual in HUF. This section, all assessees. There are different varieties of section in this whole chapter. Unless you make some deliberate attempt to get a clarity on this, confusion is bound to come there. Okay, and in examination, this confusion is the most killer kind of problem, and it disturbs the whole of the same mindset in the examination. So be very particular about all these aspects. Where you may fail, where is where the land is slippery, so trade with the caution on that particular point. Okay, so type of assessee for 80U. Who is the assessee? Individual resident in India, only resident. Non-residents, 80U is not available. And then this person is a person with disability. Okay, what is the amount of deduction? Normal disability, 75,000 rupees deduction. Severe disability, 1,25,000 deduction. What is this normal and severe? What is this severe disability? We have discussed this with respect to 80DD also. Severe disability, where the medical certified disability is of 80% or more, then the person is treated as a severe disabled person. 80% or more disability, 125 deduction. Normal disability, 75,000 deduction. Okay, this is what is plain simple 80U. But again, because we are discussing it at the final level, okay. So at final level, what is very important, same income tax you must have discussed at IPCC level, intermediate level also, but at final level, one very important aspect happens. you need to have a clarity about interrelationship of various sections also. Number of cases, there are 2, 3, 4 sections which are interconnected. Say for example, with respect to this ATU, you need to see the interconnectivity of this ATU with section 80DD. In books, you will find both these sections separately, poles apart. 80DD, 10 pages earlier, ATU, 10 pages after. But then they are connected. How they are connected? Now just consider a situation. There is a person resident in India and he is a person with disability. Now there are two possibilities. This disabled person, despite of disability, is earning. He is self-dependent. And second possibility, that this person with disability is dependent on somebody else. So if this person with disability is self-dependent, having his own income, then he will get a deduction under section 80U. This person with disability is dependent on somebody else, that other person will get a deduction under section 80DD. But in both the cases, the amount of deduction is same. 80U also 75 or 125, 80DD also 75 or 125. Why it is same? Because in both the sections, the basic criteria is person with disability. In ATU, we are giving deduction directly to that person. In 80DD, we are giving the same deduction to the person on whom this disabled person is dependent. So next time when you read 80DD and ATU together, you will get a better idea. You will get a better clarity. Disabled person dependent on somebody else, then that other person will get the deduction. Disabled person having his own income, he is a self-dependent person, then the same person will get the deduction. The amount of deduction is same in both the cases. Normal disability 75,000, 80% or more disability 1,25,000. Okay. So friends, this is what is all about deductions under chapter 6, deductions from gross total income. I have calculated my GTI. I have calculated all these deductions. Now I will get my total income. I will get my taxable income on which my tax liability shall be calculated. Okay. So this is all we are having for our today's discussion. Next class, I will be with you, and there we shall be discussing about assessment of various different types of entities. Whenever now there we will be discussing some entity specific provisions, special provisions applicable for individual, for companies, for partnership firms. Those entity specific provisions that we will be discussing on the lectures related with the assessment of entities. The first lecture would be on next Tuesday. Assessment of entities. The first lecture would be on next Tuesday. So I hope you all will be joining me there also. We conclude this discussion at this point of time. Any further queries, I can stay back, or otherwise, good night. Have a nice weekend. Thank you. Any further queries, I can take those queries here. Yeah, certain queries are there. Muthu from Ernakulam, thank you very much for the words of compliments. Yeah, Sumit, I think I have answered. 80DD and ATU both cannot be claimed by the same person. ATU can be claimed by the person with disability. 80DD can be claimed only when this disabled person is not earning anything. He is dependent on somebody else. So in a sense, 80DD and ATU are mutually exclusive. Okay. In case of amalgamation, 80JJAA is available. There is no restriction as such in the law. Okay, what about new and old regime for these deductions? That we will be discussing along with assessment of entities. Okay, the new regime and old regime, assessment of entities, we will be doing this discussion soon. Okay, I really appreciate you, Sumita. Keep on raising all these queries. It helps to generate an interaction. Keep it up. Okay, any further queries? We are getting some very good queries from South also, all these different cities from South. Ernakulam, Trivandrum, Thiruvananthapuram, Chennai, Rajahmundry. Good. Yeah, Uma, your query. House loan was taken in the name of spouse of the assessee. Repayment is done by the assessee. Can the assessee claim deduction under Section 80C? No. For house loan repayment deduction under Section 80C, house has to be in the name of assessee. Assessee should be the owner, maybe sole owner, maybe joint owner. But house is in the name of somebody else. That somebody else might be relative, might be wife. But 80C deduction won't be available in that case. Assessee should be an owner of that house, then only 80C housing loan repayment deduction can be claimed. Okay, fine. So we call it a day today. Thank you very much. Good night. Have a nice weekend.